My name is Brett Sinak with Endeavor Wealth Management, an investment management group located in Chesterfield, Missouri. And this month, being we're all getting prepared for the NCAA tournament, otherwise known as March Madness, we thought we'd come to the historic field house here on the campus of Washington University here in St. Louis. So this month, we're going to talk more about our U.S. equity-based portfolios. We have a small, a mid, and a large cap dividend growers portfolio. So before we start though, I want to ask you a question. How did your active manager do in 2016? According to the S&P 2016 scorecard, 85% of large cap managers underperformed the S&P 500. Over longer periods of time, greater than a year, the results get even worse. There is, however, an approach that has worked over time. It's called the dividend growers approach. It's not companies that pay high dividends, but companies that have consistently grown their dividends. So what does that mean? For large cap companies, it's 25 years of growth. For mid cap, it's 15. And for small cap, it's 10 years of consistent growth over that period of time. So these companies that have consistently grown their dividends tend to be high quality with long histories of profit, long histories of growth, strong fundamentals, and stable earnings. Bottom line is, when you screen for quality, generally outperformance has been the result. So does it work? Well, if you took a list of the Russell 3000 companies, so the largest 3,000 companies in the U.S., so basically the total stock market, and you looked at it over the last 20 years, the results are pretty interesting. If you just started with 4 categories and put each company into a category, the first is those that grow their dividends, consistent dividend growth. The second is those that have had flat dividends, so they pay a dividend, but they haven't increased or decreased that dividend. The third is companies that pay no dividend at all, and the fourth is companies that have actually cut dividends for one reason or another. So if you look at equal weighting those into their own portfolio, the performance is pretty interesting. The first group, the dividend growers, those that have consistently grown dividends, have averaged just under 14% a year for the past 20 years. Those that have non-changed, those that don't change their dividend, have averaged 10.1. Those that don't pay a dividend, 7.4, and the dividend cutters have only averaged 6.6%. So you're getting anywhere from 3 to 7% of outperformance just by selecting those that have consistently grown their dividend. The interesting thing though is, while the outperformance is notable, they've also done that with less risk. So a common measure of risk is standard deviation. So the standard deviation for those same group of companies over the last 20 years is as follows. For those the dividend growers, 14.5% standard deviation. The non-changers, 17. The non-payers, 24.3. And the dividend cutters, 22.3. So while we also achieve less risk without performance, that's the best of both worlds. So while that is very notable, and we like the fact that just dividend growth is a good fundamental screen for stock performance, we view it as the starting point, not the end result. At Endeavor Wealth Management, we try to make those indexes, try to perform better than those indexes by applying our own analysis. So as we prepare for the NCAA tournament and you start looking at your brackets, you'll have your own methodology you apply to filling out your bracket. It might be your favorite colors, might be your favorite team, might be based on coach, guard play, RPI, strength of schedule, conference, etc. But you apply some methodology as you're filling out your bracket. Well, we do the same at Endeavor Wealth Management. We start with the field for our large, mid, and small equity portfolios. So what we do is start with the field, the universe of dividend growers, and we apply our own proprietary technical analysis to try to pare down to get only the strongest in the portfolio. So our goal is to take an index that's already proven to beat the broad index and make it even better. So our belief is that we take that strategy that outperforms, make it better, we can provide our clients with better portfolios over the long run. Thanks for watching. To learn more, give us a call at 636-778-2500 or visit our website at www.endeavorwealthmgt.com. Thanks for watching, enjoy the tournament, and see you next month.